Well, good morning, everybody. We're allowing everybody to enter enter from the waiting room, and welcome to our Zoom recording this morning on the subject of 2022 life plus COVID. Is it going to be a horrible year or a miraculous year? You could make the decision at the end of this conversation this morning. As always, just a couple of housekeeping items. We've muted everybody on sound and video, but occasionally somebody sneaks through. If you find yourself on the screen, please go ahead and mute yourself, mute the video, because the only two people or three people who should be on screen are the three that you see right now. Don't forget, we have a chat button down the bottom. Please feel free to use that to submit questions as we proceed through the day. I try to answer those questions as the program progresses, but if not, we'll get to them at some point. And finally, we will be recording today's session as we always do, and then we'll send you a link to the session this afternoon or tomorrow. Sometimes people have to leave the programs in midstream, so we understand that you want access to the recordings. I'd like to introduce my co-host in crime on each of these Zoom meetings when we talk about the economy and finance, and that's my wonderful friend, Rhonda Buenos, Vice President of Mortgage at HSBC Bank, who is co-hosting the program with us today. Rhonda, thank you for being our partner, and any opening remarks on the state of money today?
Yes, Alf, and thank you, and good morning, and Happy New Year, and Happy Lunar New Year, early Lunar New Year to everyone. It's truly an honor once again for HSBC to participate on this event with you, Alf, and LuxeSF. So first and foremost, thank you again for allowing us to do this. I was reminiscing a little bit, and I thought, okay, we do this annual event every year to kick off the new year, and have obviously Jose Rasco, who's become well known to many of us, and I believe this is year 4, which is fantastic. Again, we are truly honored to be able to participate in it. For those of you that are not familiar with HSBC, I'll just give you a few kind of high-level highlights. We were founded in 1865. I know that's hard to believe for many of you. We are one of the world's largest banking and financial institutions. Our global businesses serve more than 40 million customers worldwide through a network that covers 64 countries and territories. While my team, as Alf said, I'm the manager of the mortgage sales team. We specialize in the mortgage side of it, obviously here to help any of you and your clients with any mortgage needs that they have. We work together as one team of relationship managers with a focus on wealth management to assist our clients with all of their own personal individual needs. We are predominantly a portfolio lender as well too, which also gives us a lot of great niches and flexibilities to assist both your domestic and international clients. So certainly feel free to reach out to myself or any of my colleagues that are on the call today to learn a bit more about HSBC and how we can help you and your clients. And now I'm going to get back to Alf for our exciting event that we have today. Thank you.
Thanks, Rhonda, much appreciated. So why today's program? Let me just read you the one paragraph blurb that we wrote about today. It says, with the angst and fear of Omicron remaining ever present, albeit diminishing, and it is diminishing, thank heavens, knock on wood, our thoughts turn to 2022 and the economic expectations for the Bay Area as we continue to battle persistent COVID variants, the economic volatility and uncertainty that we're seeing right now, and the socio-political environment that fosters division and dissent, not to mention, of course, imminent Russian invasions. It's never ending. To help provide some clarity today, we brought back the gentleman we fondly term the Nostradamus of economic soothsaying, and that's a very good friend, Jose Rasco, Chief Investment Officer at HSBC Bank. Jose is I follow a lot of economists, and there is so much jargon, so much uncertainty, so much double speaking in what they speak, and so much indecision in the advice they give that it's very hard to cut through that and get to the center cut. So the beauty of Jose is he speaks the truth, and if he has an opinion, he tells us. If he doesn't have an opinion, he says so in plain unspoken terms. So Jose, welcome back. And we've never needed you more than now, if I may say so.
Thank you.
Opening questions, sort of a classic on a scale of 1 to 10, if we can. Overall perspective right now about the economy, where do we stand today? And what's your personal mindset with respect to the economy going through the balance of the year, going through December 31st?
Well, first of all, thank you for having me. It's a pleasure to speak with all of you as usual, and Happy New Year to those of you I haven't spoken to, and hopefully you're all healthy. So number one, in terms of the economy, if I had to give it, you said 1 to 10, right? In the first quarter, it's going to be a 3. In the second, third, and fourth quarter, I think it's going to be a 7 or an 8. And we just have to be patient. Omicron is one variable, and there are others. So I think it's an economy and a set of financial markets that will be very lumpy, but we should see positive returns. It's just you have to be patient and you have to be well guided, because you can take many missteps in this kind of environment.
Jose, let's take what I've termed the canaries in the mine shaft, and just let's flip through them in headline fashion and sort of discuss or assess what impact they will have upon the economy and how they will affect it. And we know this is a moving target. Start with COVID, and we've used the terminology 2022 as life plus COVID. I mean, we're accepting the fact that we're not going to live without this beast. If that's the case, where do you stand on COVID and pandemics in general in terms of longer term effect of the economy?
12, 13 years ago, I ran wealthy at Merrill Lynch, and I wrote a piece on vaccines. And I traveled all over the country, all over the world, talking about this concept of vaccinations, right? And I got all these medical experts telling me how stupid I was and how that made no sense. And I think if you look at the world of COVID, you have to look at it as an entree to a different planet, right? So it's like a portal to a new world. COVID is not going to go away. COVID will go from epidemic to endemic. It will become less virulent, which is already happening. It will spread more quickly, which is already happening. But what's going to happen is it's going to continue to, and I think, and what the epidemiologists I talk to, we're going to see more and more of this kind of thing, right? In addition, I think it has led to a new awakening in terms of the way we think. And if you think of Maslow's hierarchy of needs, it was food, clothing, and shelter. Well, guess what? Some of the necessities now include healthcare. So healthcare has been diminished in the sense that it is now a necessity, right? And you are seeing people looking at healthcare from a totally different perspective, where they are being proactive rather than reactive and trying to focus on creating better health alternatives for them in advance of issues. And then the medical community is about to go through a major overhaul in terms of technology and what they can produce, that I think is going to improve the quality of life and the longevity of our lives across the board. So it's an exciting time.
So therefore, what's the organic effect on the economy from having this thing hanging on your shoulder all of your life?
Well, right now it's created a lot of uncertainty, but I think it's going to become less uncertain as we go forward, and we're going to learn to live with it, right? And we're going to learn to live with these things, and it's just going to be this uncertainty that we're going to have to take with us every day, no matter where we go. But I think we will adapt, like we've adapted to a lot of other things as a species and as a country. And I think we're already well on our way to doing it. So I think, COVID will become more manageable as we go forward. But that concept of greater, I don't know if you remember when we were kids, the fear, remember we would do those drills in school where you would have to sit under your desk, you'd duck and cover, because if the Soviet Union bombed us with a nuclear bomb, for some reason, my plastic desk was going to protect me from the nuclear bomb. And it's like that. It's going to be like that going forward. You have to live with the uncertainty of not knowing what is happening in the world of healthcare and diseases, but you will be better prepared to manage it going into it. So I think it's net positive, but it's just a different focus. That's all.
And the markets will react to that accordingly.
Oh, already happening. Yeah, absolutely. Look at private equity. I could go through it. We could spend an hour talking about that. What's happening with technology, private equity, and what's happening with the diffusion of 5G, 6G, and the ability to make an AI to make medicine more available, cheaper, and much more productive. So yeah, I think it's going to be much better. It's just going to take time.
Let's talk about the classic measurement of GDP, Jose. In the US, they said 21. We had what, a six point something, 6 point. We were at 6.8.
Yeah.
Where are we end of the year?
Well, so if you look at, we just got this morning, we got GDP this morning. It's surprising the upside. A lot of inventory building, right? And so typical of the market, one actually said, that's it. The inventory rebuild is over. It's not over. All right. If you look at inventory to sales ratios, they're still abysmally low, historically low. But the inventory rebuild has begun. The good news is GDP this year is going to go from 6 last year, 5.7 to 4% this year. I think it could surprise to the upside. We have 4 major themes that we have to take into account. 1 is the inventory rebuild. 2 is infrastructure, which I know we're going to talk about in a minute. 3 is sustainability. A lot of spending on environmental and social issues. Number 4 is the technology revolution we all seem to have forgotten about. It's still here and it's still coming. So GDP 4%, double the national average for the last 50 years. It's a strong year. It's just going to be lumpy.
Consumer confidence for the remaining 11 months. What do you think?
It's
absent something major like a war or
right. Yeah, well, I think consumer confidence has taken a hit. Consumer confidence is driven by many things, right? Jobs, wages, the market, right? In particular, and then taxes, right? So in terms of jobs and wages, good. The economy, right now we're in a slow period. Our first quarter growth could be close to 1%. It's going to look weak because of COVID to a large degree, right? And a host of other issues, but the weather, other things like that. The bottom line is first quarter is going to be weak. Consumer confidence is going to suffer. The market is struggling. Consumer confidence is driven by the market because 58% of the economy in this country is directly or indirectly tied to that equity market. So we feel richer and we feel better when the market is going up than when it's going down. And for now, it's going to struggle and we have to deal with that. But consumer confidence will improve.
Well, the same thing occurred. Let's assume we have 2 or 3 or even 4 rate increases from the Fed. Will that impact consumer confidence?
Yes and no. I keep in mind, we think we're going to get 3 this year. The Fed is talking about 3 to 4, well, 2 to 4, because some people are saying only 2. But the market is already priced in 4 to 6, which is insane. They're also going to reduce the size of the balance sheet. And the Fed came out yesterday and said, we're going to raise rates. I said cut, I meant raise. We're going to raise interest rates, right? That we're going to do. Let's call it 1.25, right? So you have maybe March, 1.25. And then they're going to start to reduce the size of the balance sheet. They have no idea what's going to happen. As they say in The Princess Bride, anybody who tells you they know what's going to happen is selling you something. It's never been done. We have no idea how it's going to work. The good news is they're using that as the sort of variable rate, right? So they're going to raise rates for sure. And then they're going to try reducing the size of the balance sheet. If it starts to hit the economy and it starts to go south a little bit, they will lighten up. They will adjust, hopefully in real time. The odds of it succeeding 100%, very low. The odds of failure, probably also very low. But we may struggle.
So net, you think consumer confidence will hold steady for the next 10, 11 months?
I think it's going to improve because over the balance of the year, because Omicron's, we're going to see those numbers peak nationally and come down in the next month or 2. And as that happens, we reopen the services sector. People have more jobs. People return to the workforce, and wages go up. So I think, and then consumers can go to Disney and go to the movie theater and go to restaurants. So try eating through a mask. It's not easy, as you know. So I think it'll improve.
We're going to come back to real estate at the end of this session, but while we're on the point right now, what do you think will happen to the residential real estate market overall? We have low inventories. The markets in certain key, the industry itself in certain key markets has been very buoyant and very upbeat. Your interpretation?
Yeah, I think, look, if you add a lot of money to the system, you add a lot of liquidity to the system, then there's going to be more demand. And if you don't have a lot of product, a lot of demand and few products is going to lead to inflation. So if you look at home prices, numbers are through the roof, no pun intended. And you're seeing regional breakdowns, different breakdowns for different reasons. We can go over that later if you want. But nationally, we think it's going to be a good year for construction and home sales. Even though rates are going to go up at the short end, the long end is going to be somewhat anchored, we think, Alf. And so rates will go up, but not as much as the short end. And the good news is, more importantly, unemployment rate continues to drift lower. Wages continue to rise, hopefully above inflation in the next month or two again. And that is all a positive for home construction and home buying.
Let's talk about China briefly, Jose, if we can. The GDP stalling there a little bit, 2% and change. Evergrande, you've got real estate crashes or potential impact of China on our economy next 12 months?
Well, impact, and the biggest one is Omicron, believe it or not, the COVID situation, because it's kept people going to the factory and working. And with their zero tolerance policy on COVID, it has kept production levels below where they could have been and should have been. So therefore, the number of products we're getting from China have been limited relative to what we expected. In terms of regulatory stuff, in terms of the issues with the developers and the real estate companies, that's going to stay. It's not going anywhere. That we are expecting that to continue for a period of time, and therefore it sort of looms over the market and the economy. But on balance, we think China will improve, but the government's going to have to step up and increase fiscal spending and lower interest rates. So it's a double-edged sword there.
But you don't see a global crash. You don't see a global crash that would have an impact upon where we are in the United States.
Well, the only thing that could do that is the Evergrande situation, right? That the property developers, and if the government allows them all to default en masse, and you see a massive default in the real estate and property development sectors in China. And even then, a lot of the external debt is somewhat limited. A lot of it's internal debt. And so how much of that can they pay over? And that they've done it before. We've seen situations where a lot of these companies have gotten into a bit of hot water and they've come through, papered it over, and rescued the day. They won't do it for every company, as we've seen already, but they will do it for the sector. They have to. They need to keep employment up to keep social stability. And you cannot do that in the middle of a crash or a crisis in the development sector, the property development sector. Just can't. Doesn't make sense. So the odds of that are probably not great, but it's not zero, but it's probably not great.
Okay. Let me revert to supply chain issues again. I know in my own personal experience how hard it is to get certain items. How long do we have to encounter that in the United States? How long will that go on for?
Well, it depends on what product you're looking for. If you're looking for toilet paper, that crisis is over. If you're looking for semiconductors, that's going to go for a couple of years, right? Now, we think it'll get better this year, and therefore car production up, which is another reason to be optimistic. It was really low last year because of the chip shortage and other things. And this year, we think it'll be better. And therefore, as cars get built and get sold with no need for rebates or any sort of other offsets, car dealers should do pretty well in the market. So that's something to keep an eye on. But long story short, the biggest problem with the supply chain issues is the excessive demand relative to the supply. We need to build up inventories, and that's true at every level: retail, wholesale, etc.
How long will that take?
For the world in every industry, years, 3 to 5 years. How long will it take for different industries? In the US, I think it'll be quicker because demand is so strong here. We have a lot of capital that gets attracted here and people want to sell products. So I think it'll be quicker here. But again, if you look at the car business, that'll take at least another year or two to get back to normal. The home building business, it could take several years. But that's because demand is strong. So it's a good problem to have in that respect.
Okay, let's go back to the two basics, inflation and interest rates again one more time. Are you concerned about inflation between now and December 31?
I'm always concerned about inflation because it erodes, fixed income returns and it takes away discretionary spending power. So I lose sleep over inflation a lot. But the good news is, if you look at inflation last year, took off in February and March, which means you have a higher base in February this year. So the comps are tougher. That base effect alone is going to slow inflation. And then there are a series of other things that could begin to really affect inflation and begin to see it slow more meaningfully Number one is these inventory numbers that we saw in the GDP report and the retail inventory report this morning that suggested inventories are already starting to build, even though they're still low. As supply rises to meet demand, I think you'll see that will somewhat abate. The area where we could see some problems is twofold. Number one is in homes. Home prices are up a ton. If you get a job in Denver, but you live in San Francisco, you have to move. If you can't afford to buy a house, or you can't find one, guess what? You have to rent, and rental properties are now picking up. That's about 30% of the CPI. So you could see the CPI a little higher than people think from that perspective. On the other perspective is energy prices. As the economy reopens, even if oil prices don't move, you will see demand for oil, and the regulatory environment has become harsher under the Biden administration. So everything from production, exploration and production to refining is more costly now. And as a result, is more of a lag. So the rig count won't jump like it used to in the past. And therefore supply remains somewhat more constrained, which means we could see higher prices, again, crimping the consumer a bit. But retail gasoline prices are 4% of the CPI. It's a big headline, but it's not going to kill anybody. But it's definitely not a positive for consumer confidence, you know?
Jose, ignore what the pundits are saying. In your best estimate, how many increases, how many interest rate increases this year, and what dimension?
Well, you know, we're looking at, the bank is looking for 3, right? 25 basis points each time, which takes the funds rate to 0.75 to 1% range. Keep in mind, it's not nominal interest rates that matter. It's real interest rates that matter, right? And you know, they're at 0. They're at 0. And if inflation's 7.5, we have a negative 7.5% real rate, right? So that's abysmally low. If you get, let's say, even if you went to 1% and inflation's at 3.5, if it gets cut in half, you're looking at a negative 2.5 in terms of real rates. So the economy keeps moving forward. It'll be somewhat crimped in certain respects because the rate structure may have moved up a bit. But as long as we've got good growth and inflation is slowing, it's good for margins, good for profits, and the economy probably continues to move forward, unless we get a policy error from the Fed, which again is not out of the realm of possibilities, but it's not my base case. It's not our base case.
Stock market volatility. So much of the stock market is tied to 401ks, et cetera, et cetera. Where do you see this up and down continuing for the balance of the year?
Oh, absolutely. Absolutely. It's going to be, you know, you just announced from the Fed that you're going to raise the cost of capital, right? And so therefore, all those earnings that are coming in the next few years, you have to discount that against a higher cost of capital. And therefore, you have to say those earnings will take longer to achieve, or you may not get to the level you thought you were going to get. And therefore, those equities have to be repriced. And that's what we've seen in spades, right? Especially in the tech sector, where earnings take longer. It's a different pricing schedule than most commodities. And therefore, they've been hit hard. But we think that a lot of that repricing is pretty much in the price of equities today. Probably another leg down here, but after that, we think we are back to fundamentals.
Okay. Infrastructure. We passed the infrastructure bill at some point, last year? This year, I think at now 1 point something trillion. When will that impact start to be felt as that money starts to plow through the economy? Is that this year, or is this 23 and beyond?
You know, when it comes to government spending, it's my God, you need witchcraft to try to divine when that's going to happen. There is still Obama money available in the system. There is, remember the $800 billion program, right, that they talked about. So that money is still in the system. You can still get those loans. So it could take a while. So the good news is it's going to be out there. The bad news is it's an 8-year program. So, you know, it's divided by 8, and it starts allegedly this fiscal year. But I think it's going to take time for it to get out there. The more important piece, Al, is the public markets, where we're seeing tremendous amounts of money being set aside in the trillions for environmental, social issues, affordable housing, things like that. The impact investing market is soaring. And, you know, from talking to some of the top money managers in the business, they're talking about setting aside 2-3 trillion just in environmental and social issues. So there's plenty of money out there for infrastructure. It's just not coming from the government.
Let's talk about politics for just a moment. I don't want to go. I don't want to go specifically party specific. Biden had trouble with Build Back Better, so that money's being held back. You've got the midterms coming up in November. What does the political schism do to the sort of the psyche of the economy, and do you see anything dramatic taking place in terms of the economic performance with all this dissension coming up with the elections?
Well, for consumer confidence and people's ability to feel good about themselves and feel good about being an American and being alive, yeah, political dissension isn't a positive thing, right? And all the negative rhetoric and the negative ads, they're draining, right? So I don't think anybody likes that, but either party. But it's out there. It's going to continue. There's no question about it. And during the midterm elections, it will be hot and heavy. And a lot of seats are being contested. The thought is Republicans will pick up seats in both the Senate and the House, therefore making the Democratic majority even slimmer. So that's bad news from the psyche perspective, the headline perspective. For the markets, however, anytime you have that split in government, any gridlock in government in DC is very positive for the markets because there's not a lot of change, right? Markets can handle change, but they have to absorb it. And when they absorb it is when you see this volatility. So if you don't have a lot of change, markets do well.
Historically, Jose, what happens at election time? What traditionally happens to the economy in midterms?
Well, like I said, if you get that shift in parties away from the party that currently has power to more of a split and more of that gridlock, it's usually good for the markets. Now, keep in mind, the Fed is not an apolitical animal, number one. Number two, politicians are very political animals. So expect more in terms of government givebacks, lower something to reduce taxes. I forgot how many states are returning taxes to companies and individuals because we have enough money, kind of thing, right? As crazy as that may sound. So you're already seeing some of the politicking is going on. Expect that to help add to the positive tone and maybe lift consumer confidence to a degree. But on balance, the elections will be destabilizing. And if we end up where I think we're going to end up, which is in this gridlock, it's good for the economy, but the road there will not be easy, right?
Between now and November, do you see a Democratic administration, House and Senate, trying to push through certain policies in preparation for the election, which would in any way have an impact upon the economy?
There's talk of another round of stimulus, which, I would say clearly not needed, but yeah. So you could see some things like that, the Build Back Better program. They continue to try to push that. Highly unlikely that'll go through. There's no reason for the Republicans to give in on that issue, given that the elections are not that far away, right? So it's highly unlikely they'll get a lot of those things through. But yes, I think they will try, very much so.
Okay. Let's talk about the greats, the great retirement, the great resignation, the great. Obviously, something's happening, something psychic is happening to the workforce. Care to speculate upon that, or about that, and again, its impact upon the economy, which I assume is significant.
It is significant. I mean, if you look, there's, I think, 10 million jobs available, and there's like 5 or 6 million people. But there's another 6 million people out there who could actually get a job. They're just not in the labor force. Why not? Well, some people have retired. Some people have done pretty well with the market and their jobs, and they've retired. Or they've moved to other places that are more affordable and they've retired. Other people are afraid of COVID and don't want to go back to the workforce. Other people are sitting here saying, hey, I'm a single mom and my kids are being taught, part in school, part at home, because the schools aren't open due to COVID in some places. So I can't go back to work. Some people can't go back to work. And then last but not least, a lot of the government stimulus programs really did help to keep people at home, because in many instances, you were making the same or actually more money by staying home than by going to work. So, I think some of these things are very well intentioned, but they may have had, the opposite effect as intended. So some of that will go away. Labor force will expand again, and some of it won't, right? I mean, some people had enough and they've retired. So, yeah.
But Jose, from a sort of a macroeconomic viewpoint, is this a sort of a leveling to, we talk about the fact that the boss had the leverage, now the employee has the leverage, and this is like water seeking its own balance. And what that means is an enhanced or increased cost of labor going forward in perpetuity for the corporate sector.
No, I would disagree with that completely, Alf. I think if you look, yeah, there's some more power and there's some more wage power for employees today, especially in certain, if you're a busboy, you can actually get a bonus for just taking a job, right? It's that insane. But if you're a, an investment banker, same gig as before, you may make a little more money, but it's the same, you're getting, the same kinds of wages, which are good. Don't get me wrong, but it's not this. It's not some new age of labor market tightness. And yeah, if you look at unions, they're spreading, but if you look at the pay, the number of people on them, it's going down. So the other thing to keep in mind is we've got a secular theme here of 5G and an information technology revolution that's just beginning. What are companies doing? The cost of labor went up. Great. I'll get new software. I'll get new hardware. I'll change my business and I'll hire less people. And if you talk to people locally in local establishments, diners, bar, whatever, a lot of them are doing exactly that. And they're changing their business model to require less labor. And they're using everything from hardware, software, telephony. Go to the average, pizza joint today and try to order dinner for a family of 4. You end up talking to DoorDash, not the pizza parlor. They've outsourced a lot of things that cost money, take people, and they don't want to spend the money on it. So they're already transitioning to this economy where, in fact, machines will begin to displace labor in a meaningful way. These aren't, high-tech robots. They're iPads, right? McDonald's is talking about using iPads. You won't be able to talk to a person. You just plug it into your iPad and poof, your order, you go to the window and there's your order. They'll cut employment by X% as a result. So labor costs are up. We're trying to get people back to work. And I understand that's a concern, but I don't think we're at the beginning of a wage price spiral because of it.
And so, by the way, what do you do with that displaced worker at McDonald's who's been displaced by the iPad?
Well, that's the fascinating question, right? Excuse me. And that's where I think some of these longer term trends really matter. I'm very sorry.
That's okay.
Just getting over COVID round 2. So still having a lot of these coughing problems. Apologies. But so long story short, if you look at the creation of the sustainable economy, guess what? We have to put in a bunch of new charging stations. We have to do a bunch of things to create the new grid, to put solar panels, windmill, all these things that have to be built out, the distributed smart grid. You need people to do a lot of those things, So I think that's where the labor force will grow, which is that new economy that's just beginning. Think back to Ford when they said, "Hey, Henry Ford, you're mass producing cars. That's great, but I don't see a horse. There's no horse. You use the liquid. The liquid burns. It creates a spark. It moves the car. How do I get more liquid? I'm going to have places you can go to get more liquid." People thought he was out of his mind. Well, today they're called gas stations, right? We assume them away. It'll be the same thing in 10 years with a lot of this new infrastructure has to be built.
Labor will be repurposed.
Exactly. Yeah.
Good. Corporate closures and bankruptcies, Jose, briefly, and talk to me about commercial real estate and also sort of the WeWorks of the world. Where are you seeing the whole bankruptcy and corporate decline issue?
Well, look, we're in an economy that grew very rapidly, like 6%. For the U.S. to grow almost 6% is unheard of. Right, that's astronomically high. If we grow 4% or more this year, it's tremendous, right? So I think bottom line is the economy's fine. In aggregate, there are pockets that are not fine. And there are business models that are failing, business models that are just too expensive. I mean, I can give you example after example. And so we will see, foreclosures and bankruptcies on the personal side. We will see issues on the corporate side. But I think on balance, the corporate sector, if you look at the balance sheet, is pretty healthy, cash levels at historic levels. And so some of the business models that are outmoded, yeah, you'll see bankruptcies and you'll see companies disappear. But on balance, we think the economy is strong from a cyclical perspective. And those 4 secular themes continue to lift all boats.
So to that point, let me give you some specific companies or industries, and just sort of give me the headline. Where do you see airlines headed to?
Yeah, airlines, clearly have trouble, and they're going to have to, you're going to see a lot of consolidation, a lot of M&A this year. Airlines are clearly a sector that are ripe for that, not just here, globally. And now, as the economy reopens, as the services sector takes off, you'll see some of those companies will be doing a lot better in 6 to 9 months than they are today. But I think consolidation and repurposing of airlines as an industry definitely coming. Yes.
Cruise lines, and you've seen Crystal Cruises sort of embargoing its ship in the Bahamas so it won't get hit with a court order. Cruise lines?
Similar story, right? I mean, it's an industry that, certain people love. There's a niche group of people that love that market. But I think on balance, it's going to have to repurpose, and I think you'll see some more consolidation there. I've never been on one myself, but I have a friend of mine who that's all he does. He's like a frequent flyer on the cruise line business, and he raves about it. But a lot of people, do it, have never done it, or do it very infrequently. But long story short, I think, again, given what's going on in terms of healthcare, they're going to have to repurpose. They're going to have to be very mindful of healthcare and sanitizing and all that. And I think you're going to see more consolidation. Yeah.
Hospitality, hotels, hospitality in general.
It's a similar story, but I think that's going to be different depending, just like the other two industries, domestic versus international, right? I think domestically, you may see more bounce here than you would on the international side, given what's happening in vaccination rates. In some of the developed countries, the numbers are very high, the percentage. In some emerging markets, they're, woefully low. So I think, I just guessing, but I think, the tourism business to some emerging markets where diseases were running rampant before would probably continue to struggle in this environment. Whereas, taking a trip to Disney might be a little more to people as the doors reopen, right?
What about commercial real estate?
Commercial real estate, right? If you talk about to paraphrase Mark Twain, the death of the American shopping mall has been greatly overstated. It's being repurposed, retrofitted. We're seeing a lot of experiential things come in, a lot of medical go in, everything from, horizontal farming vertical farming rather, to nursing homes and all kinds of things, right? X-ray clinics. So the American shopping mall is being repurposed to a large degree. In terms of other commercial real estate, you're going to continue to see vacancies and I think a lot of repurposing. And the medical community, I think, is going to continue to gain, because increasingly we're going to go to a more preventative kind of story, which is going to benefit both the shopping mall and the medical community.
Jose, if you were Warren Buffett and you're looking at what's happening post-COVID, and you wanted to invest and make money, what are the silent opportunities industry-wise, and what are the industries that you keep away from with a 40-foot pole?
Well, it depends on the time frame, but if you're talking about this year,
12 to 24 months.
Yeah, I think we like energy, right? Because we think prices will be healthy, and we think demand will be strong. We like the consumer here in this country. And then we like financials. I think if you look at the M&A, you look at the housing market, and we think is going to stay strong. Look at auto production. We think, financials should do pretty well. In terms of what's going to get weaker, I think goods consumption. So staples may struggle a bit. Goods consumption is through the roof, whereas services are not. So as a result, the services industry is going to see a flow of capital into it as people consume services in greater numbers again. And I think services will do well. Goods companies will struggle a bit in the next year or two, and especially in the staples space, where you're going to divert some of your spending away from those things into discretionary items that or discretionary services that you couldn't buy before. So that's some of the stuff we're looking at. And then we like technology a lot. It's going to continue to get repriced, so you have to be patient. But when you see appropriate levels, yeah, we think buying into technology makes sense.
Jose, I want to flip back and revert to COVID just one more time. We know what the pundits are saying about herd immunity and the fact that we'll learn to live with COVID. when you economists get together at the bar, what do you say? What do you speculate about when it comes to COVID and herd immunity, and it's sort of becoming just another version of the flu, and we sort of fold it into our lifestyles?
Well, it depends on which economist you're having drinks with, right? And what you're drinking. Some of these people are very pessimistic. They call it the dismal science for a reason. So a lot of economists talk about this. You can get some pretty dismal perspectives, and I try to stay away from that because I find most extremes never come to, or very rarely come to pass, right? So my view on it, and I think the view of many people, is that COVID will go from being an epidemic to endemic. We're going to learn to live with it. Vaccination rates are up. And to use the phrase herd immunity, more importantly, is the antibodies will build in the system, and most people will be. And more importantly, is if you talk to epidemiologists, they'll tell you diseases mutate, and they mutate to survive. It's a living organism. It wants to live. And so it understands that if it goes into the host and kills the host, it can't spread. So you want to keep the host alive, and you want to spread your disease as much as possible. And that's what Omicron's doing. And as a result, it becomes less lethal. And the hope is that continues to be the case. But like I said, healthcare has gone from being, not that it was ever a back burner issue, but being a necessity of life, right? It was not before. I think it's becoming increasingly an area of focus for many people. Physical fitness, trying to be proactive about healthcare, whether it's IV drips and all kinds of things that people are doing today. Proactive healthcare to prevent disease and keep your body healthy in advance, so that when these new diseases come, which they will, you're more prepared to battle it without pills and all that.
And to that point, purely from a macroeconomic viewpoint, if we got hit with a fifth surge, we got Omicron plus steroids on steroids, what happens to the economy at that point? Do we slough it off because we've been through it 3 or 4 times, or do we go into conniptions again?
Well, it depends on how bad it is, right? If it's
another Omicron.
If it's another Omicron, I think we've learned to live with it, and we can continue to advance. There are rumors another Omicron that is more lethal, and that might change the equation a bit. But bottom line is, I don't think we can go back to the days where we shut down the economy and paralyze the world, because you need to produce food, you need to get people employed, you need to produce incomes, and that's pretty clear, right? So, and not to mention social unrest and all kinds of mental illness that have emerged. So I don't think we ever shut down wholly again, but if it's lethal enough, we could see something that causes us to pull back a bit in terms of people hitting the office and going out and doing those other things. But yeah, it seems like it won't have that same impact though going forward.
I want to talk about work from home. And we talked about the great resignation, the great retirement. Let's talk about work from home. And this is a thesis that we've been pushing here at LuxeSF way back to March of 2020. We felt there was a tectonic shift. And I'm seeing the numbers. I saw extensive Ipsos research yesterday that showed that this is a permanent trend, that either 2 days a week, 3 days a week, or permanently at home. People are not going back to the office full time in huge numbers. First of all, do you agree with that premise that there is a fundamental shift in the way we live and work and play and et cetera? And then secondly, how does that affect the economy? How does that affect real estate?
Yeah, well, it's a fascinating sort of interaction, right? So I think, for example, our bank, I don't know about in San Francisco, but in New York, we've reduced the square footage, reduced our footprint in the building. And for many people, you can work from home in perpetuity. Maybe they'll ask you to come in a couple of days a month, but that's really about it. So, so that has permanently changed for many companies. I agree with you. It is causing people to also reconsider where they live. Why do I need to live in New York with higher state taxes, higher cost of living, when I can move to Nashville, no state tax, and life's a lot cheaper? I can get a much bigger, for what I paid for this house, I can get a much bigger house down in Nashville. So a lot of people are making those calculations, and that's why we're seeing the shifts in second and third tier cities, forget residential real estate, logistics, commercial, industrial. We're seeing major shifts in the deployment of those things because people are moving to states that are more attractive from both those fronts. So work from home stays. I think at some point, we've already seen it in New York and some other major cities, the government saying, hey, wait a minute, Alf, I gave you a bunch of tax breaks because you were going to bring in 10,000 people every day to the office who were going to buy sandwiches, coffee, and ride the metro. And now all of a sudden you're bringing in 10 people, not 10,000. So you want to keep those tax breaks, you better get your people back. And we're seeing that happen. And companies have to make those hard decisions, right? And you may move out of New York. You may move out of San Francisco and move to Denver. Those are the decisions that are already happening. And what they're finding is people are open to it because you can even pay me less rather than live in the valley. You know what? I'll live in Phoenix. I know you're going to pay me less, but I have a better lifestyle. So, people are already making those decisions as are companies. And I don't think that's going away. The cat's out, the secret's out of the whatever. I'm screwing up the expression.
So therefore, what does that mean for us as an economy long term?
Well, I think, look, to me, it's going to change the nature of real estate, but I don't think it devastates real estate. If you look at office, right, certainly has struggled and will probably continue to struggle. And you'll have to ask yourself, what's the footprint, right? Now, if we go forward and we find that we're creating the sustainable economy or economy 2.0, and we're creating a lot of infrastructure and we're creating a new tech revolution that's going to create a bunch of companies that are going to spin out as a result, you may find that even with the work from home movement, the number of companies created, the number of new jobs created could be rather large. And as a result, you may see that office real estate market may get snapped up a lot more quickly than people think. So it depends on a lot of variables that we really don't have the answers to yet. But on balance, yeah, under pressure in the office space business, especially in larger cities, because of all the things we already talked about, right? So I think that continues.
I don't mean this to be an unfair question because your perspective is more global and certainly more national, but I do want to zero in on the Bay Area. We're seeing the continuing headlines from the Bay Area about outward migration. People are unhappy with cost of living, crime, et cetera, et cetera. What's your overall feeling, gut feeling, or the numbers-driven feeling about Bay Area economy? Let's start there.
Well, look, if you look at the Bay, in addition to having the greatest basketball team in the history of the NBA, of which I'm a big fan, I think you've got a great economy, right? With obviously technology, finance, food, wine, but the cost of living is not cheap. We had a client apply for a loan, and when they went to open the account, the address they gave was a corporate address. And we said, no, you can't do that. You have to give us your home address. And the person actually said, I live in a minivan in the parking lot of the company I work for because I can't afford to buy a house. They have showers and gyms and everything here, and they have food. So I go to sleep in my minivan. I go to work the next morning and I shower, shave, and do everything there. That's how expensive it is. So the concept for companies to move, swaths of people into Arizona, Colorado, no tax or low tax states is very appealing. And for the individual, they're willing to make less, especially if they can work from home. So in terms of Bay Area as an economy, on balance, struggling with what's going on with tech now, but we think it's going to be very strong. But if you look at home prices are up double digits in the Bay and San Francisco, 15, 18%, depending on the survey. But look at Phoenix, they're up 30%. Look at Memphis, they're up 35. Look at Jacksonville, they're up in the mid 20s. Austin, low 30s. So prices are up, but they're up a lot more in these other cities because people are migrating. So that's going to continue, I think.
Would you advise people to move? That's a basic question. I'm just trying to get a feel for what a Bay Area denizen can expect over the next 12, 24 months. Does it get better from an economic perspective? Is there some stabilization on housing prices? What happens there?
Yeah, I think it's like everything, have that shock absorber, that safety, and that is other places. So I think prices have gotten astronomically high in many cities. San Francisco's not alone. And so you see other markets take up that excess demand, right? And so prices will rise more rapidly in other cities and in other states because labor will be moved there. And that will help stabilize the market and keep prices from rising, exponentially every year, right? So I'm hoping everybody moves out so I can afford to buy in San Francisco, but that's not happening. So I think you'll continue to see a very strong economy. It's still, you've got Silicon Valley out there, you've got the hub of technology, you've got private equity, you've got so many industries that are just booming. And I think they're going to continue to boom over the next 5 to 10 years. So I don't think that's going to change, but I think you're going to take a little top off the top, a little of the froth is going to come off, and you'll see other markets grow more rapidly. So if you're buying for investment, yeah, the large cities may not be the place to be from an investment perspective. You may get more bang for your buck. And I'm seeing that already, talking to foreign clients. They're not looking to buy into these large funds that are in San Francisco, Miami, LA, and New York. No, give me the stuff that's buying in Jacksonville and Memphis. That's where I want to be. That's the fund I want to be in. I think there's more upside there.
We're seeing DeSantis in Florida and Abbott in Texas taking victory laps about pulling people away from the West Coast and from the Bay Area. Are those victory laps justified?
Yeah, well,
or is it a headline?
No, it's justified. If you look at the numbers aren't astronomical, but they're large. And I think we're seeing it. Look at the logistics companies, right? A lot of companies like Amazon and others that were going to do stuff in large cities like New York and San Francisco. Yeah, now they're looking at Memphis and they're looking at building facilities on the outside of Jacksonville. So it's already happening. You're seeing these second, third tier cities are being moved up in terms of investment flows. And on the margin, it's coming from the large cities. So it's not a death knell for the large cities by any state of the by any state. But bottom line is those other cities are catching up because of all the things we talked about.
Real estate markets sort of inside the core set where San Francisco and the Bay Area operates. Just sort of a headline. What's happening in Manhattan?
Well, Manhattan, you're seeing rents have come back. I mean, rents are back in a big way and prices are back for the most part. Manhattan's a tough market though, right? Because it's an island. It's got limited capacity. And you can build up, obviously, but even that has become limited. So I think we're seeing the return of Manhattan, but it's not what people thought. It didn't happen as quickly as people thought. And we're not growing at the rate that we thought. So it's back, but again, it's dwarfed by some of these other places.
The Hamptons?
Well, look, I mean, that has ebbed and flowed. We've seen where that just boomed and demand for real estate at the beginning of COVID was monstrous, right? And then we saw that it sort of stopped and people said, I can't afford it, or it's too much, or there isn't enough availability. So they started looking elsewhere. And you see people now living in other parts of the country that you never would have thought. So, and that's happening. So the Hamptons, it's one of those places that will always be strong because of what it offers, geographically and in terms of natural beauty. But, and it's a place everybody wants to be for obvious reasons, but clearly some of the steam has come off that market to some degree as well.
Miami-Dade?
Well, Miami's, there's an old joke. I'm of Cuban descent, and there's an old joke. Why did the Cubans move to Miami when they left Cuba? And the punchline is because it's so close to the United States, right? So Miami is part of the US, but it's really a very international city. And that remains hot and maybe too hot, right? And demand for real estate and many, many forms remains a very big business. So you have a lot of people coming from other countries. I just got off the phone with someone who came from Mexico and living just north of Miami, and very wealthy individual, but had trouble finding a place. It took a while and paid a lot more than she thought. So it's still in demand, but it's more that international flavor. So it's a very different market. So yeah, but it's still strong. Yeah.
Two more, if I may. Austin?
Well, Austin is a different market, right? It's in Texas, right? Like Miami is in a state with, where the tax story is more advantageous, and it's definitely on the rise, it seems. So it's one where if I look at the prices, I don't have the number off the top of my head, but it was pretty strong.
And finally, Scottsdale, Phoenix?
Well, another one that, are very strong in terms of price increases. So suggesting that demand is pretty strong there. Yeah. The
We're
other
also
one,
see,
Jacksonville, is another market that everyone I talk to is talking about Jacksonville for a variety of.
why is that? It's a terrible city.
And then it's not overly large, and it has a lot to offer in terms of amenities for wealthy individuals, and for the bang you can get for your buck. I'm just making up numbers. For $2 million, you can get something right on the water, and it's a monstrous. Whereas 2 million somewhere else doesn't buy you a whole hell of a lot, right?
Ponte Vedra and all that area, Jacksonville beaches, etc.
Yeah. So
One other quick question. I keep hearing that about the migration and movement to Wyoming, to Montana, Jackson. That's verified by the numbers from your perspective as well. Yes.
Yep. Absolutely. Yeah.
Okay. We're at the sort of the 4-minute mark here, Jose. We could go on for a long time, but I guess we should wrap up. But I am worried about your coughing. And you said COVID number 2 for you now?
Yeah. Second time. A lot easier.
A lot easier.
I'm getting the hang of it now. Yeah.
Getting the hang of it.
Our question up a couple of times about equity markets, Al. And if I could just 2 seconds on that.
Yes.
We're repricing equities to allow for the higher cost of capital. It's not over. And when the Fed begins to reduce the size of the balance sheet, we don't know what effect that's going to have. If you look at when you add money to the system, M2 was growing 25, 30%. Now it's down to 12%. It's going to go back to 6. And as that happens, combined with higher rates, combined with draining liquidity, expect more of this volatility. Very volatile year. Corporate profits bottom up 9, 10%, top down 15 to 20. We think profits are somewhere in the middle between, let's call it 10 to 15. That's a good year by any measure. That's a good year. And we think equities could be up a fair amount, double digits.
Double digits.
Yeah. But we're in a hole. So we have to get out of that hole. It's going to be lumpy. It's going to be volatile. If you want to have those conversations, let me know. We can certainly get on phone calls or do follow-up calls and put you on with some of our investment people as well. But it's going to be very lumpy and bumpy, but we think it's a good year here in the US. And, if you're invested, don't try to be cute.
Stay there.
But look for quality companies and look at hedge funds, which are non-correlated assets. So even if equities do a lot of this, as they go up, hedge funds can mitigate some of that bumpiness.
2 quick questions and we'll wrap it up. Jose, I've got a question here. Are you expecting substantial equity transfer from foreign nationals to the US in terms of real estate investments?
Yes.
From what part of the world?
They're concerned. I have these conversations every day, Asia and Latin America in particular, Middle East as well. But those are the 2 areas of the world that I deal with a lot. A lot of money wants to come here, and it's struggling to get here and struggling to find a home, but it wants to come. And I think, and if you look, I can't tell you how many people are talking about opening real estate funds. The one thing we didn't talk about at all is cryptocurrencies. And I want to be really careful how I address it. But if you look at crypto, you look at DeFi, seeing the creation of a lot of product that is going to be very focused on the real estate markets. And that will allow foreign inflows of capital, not because they're skirting the system. No, they're working with the IRS and the SEC, but it's a lot easier for that transfer of wealth. And as a result, I think you'll see inflows of capital, but they're concerned about high prices. That's why they're looking at these 2nd, 3rd tier cities.
On crypto, if we're not following crypto right now, should we be?
Absolutely.
No, and certainly within real estate, even there?
Absolutely. Oh, especially there. If you don't know what crypto is, if you don't know what NFTs are, if you don't know what DeFi means, call me. Call me, read a book. You have to know. If you're a real estate broker and you don't know what those 3 things mean for your business in the next 5 years, you're in the bug with.
We need to do a program. We need to do a program on crypto.
Yeah.
You're validating that. Final question. If I was looking at 2 canaries in the mine shaft between now and December 31, read the economy, they would be what? What should I be looking in the headlines for?
Well, look, I think everybody's focused on geopolitical stuff. I'm not. I don't, self-interest will rise above that. And even if things happen, we'll get our way through. One is obviously health. COVID, right? That's one thing to keep an eye on. Number 2 is interest rates and the lowering of that balance sheet. What does it mean for the economy? As they're raising rates and doing several other things, and lowering the rate at which they print money, you're raising rates and you're going to lower the balance sheet, and that's what you want to watch. So we're going to monitor that, and we can certainly get back on a call in the next as we hit March. They'll begin to raise rates in March, and let's talk about where things are then. But the economy is going to improve. COVID is going to subside, and we think we're going to have a good year, but it's going to be lumpy and bumpy, and prepare for that volatility. So.
Jose, we love you. We love listening to you. You always elucidate, which is a hard thing to happen nowadays. To our questions coming in here, yes, we will do a crypto program. Let us sort it out, and we'll get that organized. I want to thank you very much. I hope you get better. Please don't get it a third time.
And on that crypto thing, if you want, let me know. I have a couple of friends who are very in that space, really know what's going on. NFTs in particular, commercial real estate is going to be monstrous. And if you look at the DeFi market, you have to understand that market.
We will do it. Jose, thank you very much. Rhonda Munoz from HSBC. Rhonda, thank you for hosting us again today. We're at the top of the hour. We thank you. We're going to shut this thing down. We will send out a recording to you later on this afternoon. There'll be a link, a Zoom link, and you'll be able to watch this again at your leisure. And with that, ladies and gentlemen, and Jose, we are adjourned. Thank you for joining us today.
Thank you. Pleasure talking to you guys as always.
Thank you, sir.